Hey everyone, welcome back to Corporate Decoder, the place where we break down those dense corporate filings so you don't have to. And today we are looking at an amendment to InMed Pharmaceuticals, Inc. Its annual report, specifically an amendment that adds in a whole chunk of missing information. So let's see what they added. What if I told you that companies sometimes forget to include major parts of their filings on the first try? Well, InMed Pharmaceuticals Inc. seems to have done just that, and now they are filing an amendment to backfill those missing pieces. And we are going to dive into what that means for them and for us. So this filing is an amendment to a previous report called a 10-KA. This is basically an update where they are adding in parts 3 and 4 of the report. They originally left these out, hoping to include them by referencing a different document, a proxy statement, but they missed their deadline for that. So now they are just putting the information right here. Think of it like forgetting a chapter in a book and then having to add it in as an appendix later on. Let's start with the people in charge. InMed Pharmaceuticals has a board of directors and a typical set of executive officers. We see names like Andrew Hull, Nicole Lemerand, and Brian Baldassar serving as independent directors. Then there is Eric A. Adams, who is not only the president and chief executive officer, but also a director. This usually means great insight into operations, but less independence. There are also other executive officers like Neda Jagpal, the chief financial officer, and Michael Woodenberg, the chief operating officer. The report details their backgrounds. Their roles on various committees like the Audit Committee and the Compensation Committee, and confirms that while most directors are considered independent, Adams is not due to his executive role. They also have policies in place to prevent insider trading and hedging, which is standard for public companies. Now, who is getting paid what? This is always a juicy part. InMed's compensation philosophy aims to attract and keep good talent, reward performance, and align executives with shareholder interests. They use a mix of base salary, cash bonuses, and stock options. They hired an outside firm, Aon Radiology, to benchmark their compensation against similar companies in the biopharmaceutical space. Their goal is to keep cash compensation around the 25th percentile of the market, but equity compensation around the 50th percentile. This means they are trying to conserve cash for research and development, while still making their executives feel invested through stock. Looking at the summary compensation table, we can see the actual numbers. For the fiscal year ended the 30th of June 2025, Eric A. Adams, the CEO, took home a total of $396,973. Michael Woodenberg, the CUO, earned $347,123. And Eric HSU, the senior vice president, brought in $323,623. Neda Jagpal, the CFO, earned $303,720. It is important to remember that these salaries and bonuses were paid in Canadian dollars and then converted to US dollars, so there is some currency fluctuation to consider. The stock option awards are listed at their grant date fair value, which is an accounting number, not necessarily what the executives will actually make. These numbers are not wildly out of line for a company of this size in this industry, especially considering the compensation philosophy aiming for lower cash and higher equity. They also have a stock option plan in place, allowing them to grant options to directors, officers, employees, and consultants. The number of shares available is capped at 20% of outstanding shares. Exercise prices are set at market value, and options generally have a 10-year lifespan. Let's talk about who actually owns the company. The table here shows us the beneficial ownership of common shares. As of a recent date, we see some significant shareholders like Savvy Volatility Warrant Master Fund, Limited, holding nearly 10%. Then we have the directors and named executive officers, Eric A. Adams, the CEO, for instance. Directly owns a small number of shares and holds options for more, amounting to about 0.34%. It appears that most of the executive ownership is tied up in options, typical for companies wanting to align their employees' interests with stock performance. The tables here are showing us the breakdown of their equity compensation plans as of the 30th of June 2025. We can see there are about 64,410 options outstanding, with a weighted average exercise price of $32.53, and there are about 41,278 options available for future issuance. They also report their annual burn rate, which is the percentage of options granted relative to the total shares outstanding. For 2025, the burn rate was 3.01%, which is a decent number. Not too aggressive. The filing also touches on related party transactions. It mentions that the company uses legal services from Norton Rose Fulbright Canada LLP, where a former director, Janet Grove, is a partner. While she resigned, the company still accounted for the legal fees. These fees were around $316,977 for the period up to her resignation, and $226,793 for the prior 12 months. They also have policies to manage these related party transactions, requiring board approval for any significant deals. The directors are also indemnified for certain actions by the company's articles and specific agreements. Finally, we look at the auditors. For the fiscal year ending the 30th of June 2025, the company paid $212,000 in audit fees and $17,000 in tax fees to their auditor, CB CPAs PC. This is down from $372,000 in audit fees and $35,000 in tax fees the previous year. It is worth noting that CBI CPA's PC acquired the Attest business of Markham LP in November 2024 and also billed for some audit fees before that acquisition. The audit committee has a policy to pre-approve all services from the independent auditor. Now, looking at these filings more broadly and putting on our Warren Buffett hat, InMed Pharmaceuticals Inc. seems committed to a strategy of cash conservation and long-term value creation through equity. The fact that they amended their filing highlights a bit of disorganization, but the core information added provides a clearer picture of their leadership and compensation structures. It's a common practice for companies to leverage stock options to attract and retain talent, especially in the competitive biotech sector, and InMed is doing just that. However, the relatively high number of options outstanding compared to available shares for future grants, coupled with the burn rate, suggests that if they continue to grant options at this pace, they might need to increase their share reserve in the future. The focus on director independence is a good sign for good governance, but the fact that the CEO is also a director means that balance needs careful management. The compensation numbers themselves appear reasonable within the disclosed benchmarks, favoring equity over cash to fuel their R&D pipeline. So, what is my take? InMed is playing the long game, and they are using equity as a key tool to get there. The amended filing, while a bit clumsy, ultimately adds transparency about their executive team and pay. The main question will be whether their R&D pipeline can deliver the growth needed to make all those stock options valuable. It is a risk, but it is standard practice in this industry. Alright, that is our dive into InMed Pharmaceuticals Inc. Amended filing. What do you think of their compensation strategy and their focus on equity? Does it inspire confidence or raise any red flags for you? Let us know in the comments below. If you found this breakdown helpful, give us a like and subscribe for more insights into the corporate world. And don't forget to join our Discord community, linked in the description for more in-depth discussions. Thanks for watching, and we'll see you in the next video.